Okay, a little bit of information on the applied level before we get started. In the description box, you'll see the link for both Instagram and X. I've been asked if I can give updates whenever there's a new video. How do we get updates? Being that this website that I'm on here is not really mine, I can't really command the IT team to do anything. I'm going to use Instagram and X to put out the notices of when anything is new. So over the last week, I did put one out on X and Instagram for US CPI. New video was added. So if you are an applied level subscriber, or even if you're not an applied level subscriber and you just want to be aware of what is being added to the applied level, go ahead and subscribe to either of X or Instagram. I will only use those two for notifications. So it's not as if I'm going to bury you with 5-6 messages every single day about stuff that's unrelated to anything. They'll only be used for notifications. So in the top-down folder in sector studies, if you click on there, you will see economic reports. I've added US CPI. I'll be adding PCE this week. I will add all the big economic reports and how to read them, how to break them down, if there's any extra data where you can find them. So they'll just be added in here. So this week I will add PCE. I'm also currently working on the auto industry, and I'm pretty much done the research part that I need, and I am pretty much done my walkthrough of GM, Ford, and Tesla. We're going to read segments of GM, Ford, and Tesla's statements to get an idea of where they are, what they're doing, and to understand, where they are and what they're doing. We do have to understand something about the auto industry. I'm hoping that I'll be done my screens this week and that I'll be narrating this next week, so that next week I'll be adding the auto industry to the list of sub-industries that I've been doing. And the auto industry will show up in consumer discretionary because, well, that's where it's situated. With that said, let's head on in. A boring week over week in terms of rates and yields. Looking at money market rates, hardly any move. We wouldn't expect it. It's going to reflect monetary policy, and that hasn't changed. Capital market yields relatively unchanged week over week. The 10-year coming in at 0. Looking at curve inversions, we are still inverted. The 2 to the 10 started the year at negative 35. We're sitting at negative 37, and we really haven't fluctuated much around that. Some weeks it goes a little higher, some weeks a little lower. The capital market curve, the 3-month to the 10-year, started the year at negative 152, still inverted, negative 97. Canada much deeper, negative 125, and on the capital market inversion, 60 basis points. Last week, we did get a rate cut in the world. Sweden cut 25 basis points, like they said they would. And they also said that they expect 2 more over the course of the year. It is expected that the ECB is going to cut when they meet early June. I expect the Bank of Canada to cut at their next meeting. I've been talking about the financial sophistication of economies for quite some time, that the U.S., that one of the reasons why we're not seeing a lot of fallout from higher interest rates in the U.S. Is the level of financial sophistication, the amount of securities that are available and financial tools that are available to hedge against interest rates. That companies do this with swaps, and households do this with fixed rate loans. Probably the biggest tool for households is the 30-year fixed rate mortgage. So 2019 rates were what, 3%, sometimes sub 3%. So in 2024 in the US, they're still sitting at 3%. But that is unique to the US. Canada has 5-year fixed terms. So in 2024, what was 3% in 2019 is going to reset at 7 to 7.5% in Canada. Same with the UK, same with Sweden. So these economies where the sensitivity of interest rates is much higher, it becomes much more necessary for central banks to consider the fallout that would happen because of this. So in Canada, for example, mortgages in 2019, I can remember these were 2.7, 2.8, 2.9. They were sub 3%. They're going to reset. So we go back to 2019, you look at the number of homes that were sold in 2019. That's how many mortgages would have to renew on average in 2024, which is expected to take $2.5 billion of extra interest payments out of those people walking back into banks. Just the reset will take $2.5 billion. Consider the multiplier, your $4.5 billion that will be taken out of the economy this year, just in extracting more interest payments out of homeowners that would have otherwise spent that money somewhere else, which means about a $550 to $600 million hit to tax revenues this year. So we're already running a deficit. We already have a spending problem, and now we're going to incrementally lower the revenue a little bit more, so that spending problem will get worse. When you look at that type of sensitivity, it's hard to imagine a central banker that is willing to ignore that. Sweden wasn't. The UK probably will not, and Canada will not. So that other central banks cutting before the US probably makes sense, in part because of the lack of household immunization against changes in rates. There might be something in these countries looking at the 30-year fixed rate and saying, well, why do we not have a 30-year fixed rate here? Fed balance sheet down $9 billion week over week. The SOMA increased 100,000. That's nothing. That's probably just an adjustment on the tips. Unchanged on the balance sheet or on the SOMA account, and net runoff on the balance sheet, call it $9 billion. For money markets, we have an increase of 31 billion, another increase. Retail increased by almost 8 billion, institution increased by 23 billion, and all categories both increased their government exposure, both increased their prime exposure as well. Okay, this is becoming a bit of a crowded screen. I may have to change the format of this a bit. June 12th, FOMC is 31 days away. We get the last FOMC minutes in 10 days. For June, there is no expectation of a move, 96.5% of nothing happening. Going out to December, having no or one cut, only one or no cuts, 47.4%, up from 40%. More weight to saying no, the central bank doesn't appear to want to move. More than 3 cuts, probability is 2.5, down from 4.7. I think this is probably right, but I think this is incorrect. I think we'll end the year somewhere either 4.75 or 5, but I'm still thinking this is where we would be. Let's move down this way, and then we'll come back and pick up over here because I want to discuss CPI a bit. New York Fed, effective federal funds rate still sitting at 5.33. Reverse repo up 36 billion from 450 to 486, up 36. Again, the lowest is still April 15th at 327. I don't know what I can say about this increase. It could be with the Treasury actively rebuying things right now, that there is a lack of securities, and that is going into the reverse repo. TGA down 73 billion to 816. So if they are repurchasing securities in the money market space, the lack of 73 billion of securities could account for an increase of 36 billion in the reverse repo. Reserves 3.33 trillion, up 13 billion. So 1.3 billion roughly to run off before we get to the 2.5 trillion, which is not a number that the Fed has put out. I've said this before. It's my guess as to where ample is going to be. 32.92 months at 40 billion runoff a month. We're 3 years away really seeing much action here. I don't know that it's worth continually reporting these levels here if we're preparing for something that's 3 years away, right? PPI we get in 2 days, CPI we get in 3 days. And I just want to point something out. If you have the applied level, I did put the CPI report, how we read the CPI report, and all of the information we would get in the CPI report. I did do that. It's in the top-down folder in sector studies. And I'll be adding PCE this week because those are the two big reports. I thought I'd add retail sales, but why not put PCE in? If we've got CPI, let's put PCE in so we understand the difference between the two and how we would read the PCE report. We get that in 3 days. If we use the database, what is not given to us in the CPI report is the seasonally adjusted price index. We have the unadjusted price index. We have to go to the database itself to get the seasonally adjusted index. So I put it up for the 4 months and recalculated with more decimal places what both headline and core CPI is. In January, we got a reading of 0.3 and it was 0.305. So yeah, pretty much. In February, we saw 0.442. That's rounded down to 0.4. And in March, it was 0.378, and that is rounded up to 0.4. So if we look at headline, we had 0.3, 0.4, 0.4, and we conclude that we've made no progress, but we have. 0.442 back down to 0.378. If we look at core, January was 0.392. That's rounded up to 0.4. February, it dropped to 0.358. That's rounded up to 0.4. And then in March, it pretty much stayed the same. So we can say core has been unchanged over this month. That would be correct. But to say it's been unchanged over 3 months is not true because we went from 0.392 to 0.358. And in headline, 0.442 down to 0.378. We are still making progress on inflation. It's just when you round to the nearest decimal, you lose a lot of information. So we have inflation, CPI coming in 3 days. And there I'll do the same thing. I'll go to the database, I'll look at the indexes, and I'll see what the second and third decimal place is. There is an expectation that it is going to come in lower, and if it does, then I think bonds will get a rally. And maybe 3 cuts priced back into the curve in the Fed funds futures. Monday, you have Jefferson and Mester. Tuesday, Cook and Powell at 10 a.m. Watch this one, Powell at 10 a.m. Wednesday, Kashkari and Bowman. Thursday, Barr, Harker, Mester, Bostic. Let's see if he is going to be friendly to the markets again. And Friday, you have Waller. So in line with the boredom from the first screen when we looked at capital market yields, real yields, also boring week over week. Inflation, break even, super boring week over week, really nothing going on here. The Fed funds futures pricing in 42 basis points of cuts over 2024. Last week was 47.5, almost unchanged, versus 75. I still think long Fed fund futures makes sense. Looking at TLT, we did get some movement here, up 0.31 week over week. Trailing SPX, which was up almost 2%, up 1.85. Implied volatility pretty much staying the same. In both these periods of time, I tried for the June 89 put on TLT at $1.30. I think it got to like $1.20. I think I saw a print of $1.25, and I thought, okay, a little bit more weakness, and I got them for $1.30. I got too greedy. I never got them on either day. I will try again this week. If I see any weakness on TLT, I will try again to sell puts, but I am greedy. I want a certain price. I mentioned this on the first screen. Sweden cut 25 basis points. They are expected, from their own words, to cut 2 more times this year. ECB June 6th, they are expected to cut 25 basis points as well. BOE at their next meeting is expected to cut. And Bank of Canada, well, they were expected to cut, but because of the very strong jobs report, economy created 90,000 jobs, there's some thinking that that took the cut off the table. I'm still leaning on the probabilities being more than 50% for a cut from Canada. Some relief in mortgage rates, down 13 basis points week over week, Thursday over Thursday. Same with the 10-year Treasury, so the spread remains the same at 264 basis points. This week in housing, what are we getting? NAHB Housing Market Index for May. The previous read was 51. The expectation is 51. We have building permits, the preliminary look at building permits for April on Thursday, along with housing starts for April. I will come back to ABR in a second here. For OAS, more contraction, except for CCC. In fact, we're almost at pre-pandemic levels on the tightness of these spreads. Nothing to see here, really. Tuesday, total household debt for Q1 for 2024. All we have, and we only get this quarterly, and we have stale numbers. We have Q4 of 2023, so it'll be nice to see where we are as of Q1. Let's look at ABR. I added 5,000 shares on the earnings released date because it had pulled back to 12.75, a little under 12.75 after opening somewhere around 13.40. I thought that was overdone, so I bought. The short reports are back out again. Same group of people, same, low quality group of people. I bought another 2,500 shares on that weakness as well. ABR up 1.63% week over week, not bad. Here's a longer term chart of ABR. They seem to be stuck in this channel where they just can't get much elevation above 13.50, but they're well supported at the $12 level. Dividend of $1.72 a year, given the current price, is a 13% dividend yield. I'll pick that up. I also posted on YouTube a ABR short report defense that I had posted in the applied level last fall, but it is rather dated now. It is defending ABR from a more intelligent short report that was written earlier in the year, last June. But the short report coming out with Viceroy is basically just a repeat of the more intelligent short report with a lot more grammatical errors and a lot less intelligence. So I thought, well, let's put that out because the defense remains the same. No matter what period I defended on. Expect Viceroy to keep doing this every quarter when our ABR reports earnings next quarter. The very next day, they'll release the same short report again in slightly different form, and they'll just keep repeating the same uninformed statements. It's 4 hours long. It's a long one, but if you are interested in ABR and you really want to know how to defend against that short report, go ahead and read that one, or go ahead and watch that one. I'm comfortable taking a long position in this company. I've known it for a long time, and I've never missed a dividend. They've never not paid. They canceled their dividend before the financial crisis, but so did everybody. But since then, they've only gone one way on their dividend, which is up. They've gotten through this whole rate hiking cycle with about a 33% loss in market cap. They were as high as $18, and given where they are now, a third of their market cap is gone. So the short reports suggesting that this is a troubling time for ABR, it's priced in, and they are navigating through this, I think, quite successfully. You're a company with a significant track record of getting through difficult periods. So have a look at that video if you are interested in ABR. You'll get a really good understanding of what CLOs are, what bridge loans are, what transitional properties are, and the cash flow nature of transitional properties, and the process of going from a bridge loan and a transitional property to a GSE is important to understand, and how things change when that happens. Once you go through that, then you can go ahead and read the Viceroy thing, and I think you'll only get 2 pages in before you stop and say, okay, this is full of lies. Okay, can't not say something about copper and gold, both Newmont and Freeport. Here, Freeport, lots of copper and gets gold. Newmont, lots of gold and gets copper. For copper, 466.25. The 1-year high close was 467.25. We're 0.3% below a 1-year high on a closing basis for HG, which is the futures price for copper. Looming supply concerns. More and more you're seeing stories about how much capacity is available in the world in terms of copper mine, the length of time it takes to bring a copper mine online, the potential social pushback in certain countries over it. Again, Panama with First Quantum with their mine that supplied like 5% of the world's copper, now gone. And regulations will drive EV production, and EVs use a lot of copper. When I say regulations will drive it, the market seems to right now be uncertain whether it wants to buy EV or ICE. But there is no choice with regulations over the next 5 years on fuel efficiency standards and emission standards. The reduction you have to get in emissions on a fleet basis, and the increase in fuel economy you have to get on a fleet basis. Very difficult to do that just with technology on ICE, that in your fleet you're going to have to introduce plug-in hybrid or electric vehicles to get the fleet mileage that you need. So, and it's not just the US. China has regulations that really push it. Brazil, the European Union, Canada has adopted the EPA guidance. So it's globally, and you do have a copper issue, and you have regulations that drive an aggressive EV transition. So this can continue, and I've been touting copper for quite some time. This can continue for years. It wouldn't surprise me to see copper at some point over $6 a pound. I just don't see this steepness, this trend continuing without some pullback somewhere. If we look at gold, 23.75. The 1-year high close was 24.13. This is on the future, the continuous futures contract. 1.73% below the all-time high. Dropping rates are supportive of gold. As central banks drop rates, that gives gold a bid. Higher rates should be pushing the price of gold down, but it just doesn't seem to have done that. We could probably attribute that rally to the belief that rates are coming down, much like the Bitcoin rally was in the belief that the halving would double the price of Bitcoin. That once the halving showed up, you would not expect the price of Bitcoin to double from that point because it already had. So it's curious to see where gold is going to go from here. If we think that this increase in price was pricing in eventual rate cuts, then it's already in. We just might go sideways for a period of time. Whereas with copper, we can point to supply concerns. Now you could say the same thing for gold. You can say with the demand for jewelry every year, there is a demand for incremental new production of gold every year. And yields in ore have been dropping over time. So that the production of gold, unless you find significant new gold finds, which most mining companies and geologists would say probably doubtful at this point to find significant deposits. If yield continues to drop, then for the same production, you're going to produce less and less gold. So you could have a looming supply shortage of gold, where you could only get more gold if you have a higher price to justify, to make some of the resources out there into reserves, and those reserves economically feasible to mine. If you're playing futures, keep in mind these are big contracts. Copper is 25,000 pounds. So every contract has a notional value of 116,000. Gold is 100 ounces per contract. So every contract is a notional of 237,000. Freeport finished at 51.59. I am short $50 calls on half, and those expire May 17th. I'd like it to finish at, by the end of the week, $49.99. I'm not asking much, $49.99, $1.60 down. If not, that's okay. I got a break even of $50.90. I can live with that. Newmont sitting at $42.49. I'm looking at the $40 put in the 70 to 80 cent range. That is the offer that I'm willing to make. So any weakness on Newmont, I will look at the $40 puts. Well, we have to talk about Tesla. It just seems to make news every single week. Down 7% week over week. Last week I reported that I took a short position in Tesla using a risk reversal, a 245 call, sold the 245 call, bought the 150 put. Each risk reversal is now up $692. I only did 10 because, you are being basically potential exposure of being short 1,000 shares on Tesla, and it has a cult following, so I didn't want to get more aggressive than that. But each risk reversal is now worth $692. Tesla now under investigation for securities fraud and wire fraud related to how they have positioned or marketed, or their marketing message around autopilot and full self-driving. Waymo reported this week that they're doing about 50,000 robotaxi rides per week. If we figure about $8 per ride, $400,000 a day, they got about a $20 million a year run rate in just 3 locations, 3 geofenced locations. But if we're looking for robotaxi success, Waymo already there. GM has restarted Cruise, very, very small, but has restarted Cruise. So is generating some rides per week. These are, both the Waymo and the Cruise are level 4 vehicles. Level 3, just so that you know, first of all, Tesla's level 2. Level 3 means you still need a driver in the front seat, but the driver their attention can wander. At level 2, they must be attentive. Once you move from level 3 to level 4, you don't need the driver behind the wheel. The driver can sit in the back seat. And once you get to level 5, you don't even need a steering wheel or gas or brake pedals in the vehicle. So the Waymos and the Cruises are level 4s. And by necessity, they're going to be geofenced. But that is still impressive, 50,000 robotaxi rides per week. Biden administration set to announce 100% tariffs on Chinese EVs. They're currently at 25%, wants to bring it to 100%. China right now is faced with overproduction and overcapacity. Not only that they're overproducing, it's just that they have overcapacity. And with the fixed structural costs that automotive companies face to keep their costs low per vehicle, you have to continue to produce, so you will oversupply. And when China oversupplies, they dump it on the world market. So the U.S. is getting proactive on that, saying, well, we have to protect our domestic suppliers. So 100% tariff, I would look for China to retaliate. That's a dangerous thing to do with China here, because as far as the processed materials, not the mined materials, once you mine something, you still have to process it. As far as the processed materials, China almost has a monopoly on this. 97% of the world's processed graphite comes out of China. So if you want to keep pushing EVs, and China says, well, you want to do that? Fine. No graphite is leaving this country. Well, you're screwed. That's it. China can shut down the whole supply chain on EVs with just that, saying, listen, we're going to reduce the amount of material that leaves the country. You think that us importing vehicles into your country is a threat to the growth of your EV industry? We will put you in the same position by restricting the export of certain materials that you need. You're going to lose anyways. So I would look for some kind of retaliation from China, and it's most likely going to come from the processed materials that are necessary for battery production. Tesla fired its supercharger team and canceled new builds. A bot later on X said we are still going to invest $500 million in incremental capex, not maintenance capex, but incremental capex on our supercharger network. A lot of conflicting information coming out of this company. They say that the last statement you had on the low-priced vehicle was that, yeah, we are going to do it sometime in 2025, look for it. But then you hear reports from unnamed sources that say, no, it is canceled altogether. There is going to be no low-end vehicle. And you have, well, we've laid off everybody from our supercharger team, and then, several days later, a posting on X saying, we're still spending money on it. We're still going to do this. Well, why did you get rid of 100% of the supercharger team for it? Right? It makes you scratch your head. EVgo. Sales year over year, they reported earnings. Sales up 118%. Electricity delivered per stall up 120%, roughly 17 megawatts per stall. What that shows is that there is demand at charging stations. I mean, demand is up 118%, while the electricity delivered per stall, if we look at it, kind of like same store sales, 120%. So the demand is there. So the canceling of it, just as everyone seems to be adopting the standard, seems rather curious, right? I mean, I think even a Tesla bull has to stop and say, well, that didn't seem to make a lot of sense. BP is rumored to be looking at Tesla's supercharger network, whether they're interested in making an offer to buy the whole thing or not. But they are looking at hiring Tesla staff. Same with EVgo. They've basically just come out and said that hey, come here, we'll hire you guys. BP's the rumored number for the supercharger network is $1 billion. I don't know that it's worth it for Tesla to sell it. If they're going to spend $500 million on expanding it, they get $1 billion for everything that they have. If the $1 billion is the right price, I don't know. But if you're gonna have EVgo and BP rehire everyone you just got rid of, I don't know. You scratch your head and you wonder, well, what is the logic here? So there could be two stories. Number one is they see the overcapacity in the industry significantly increasing. And this industry, the auto industry, is known for overcapacity. It operates in an overcapacity mode all the time. The pandemic was a rarity. So if you're going back to overcapacity, margins disappear very quickly because you have to use a lot of dynamic pricing. If you don't have dynamic pricing, you use incentives. Incentives are dynamic as well. So margins tend to disappear. It could be that Tesla sees that, as it said in its own report, they are between two waves of demand. The initial buyer's wave is dropping, but the mass market wave has not increased yet. They're between these waves. You have to conserve cash, so you got to cut a lot of things. So they could just be doing all of this stuff to say, look, we got to focus on survival here over the next 6 to 8 quarters, or maybe it's 2, maybe it's 3 years. We have overcapacity building in every market. We have everybody that is moving into the EV space. So if we're going to survive, we're going to have to get lean really fast. That could be going on. The other side of it, the other argument, is that they are so far advanced on full self-driving that they're going to, that they can make the leap from going from level 2 and say, we're just going to skip over level 3 and go right to level 4. We are that far advanced that that's the biggest market for us right now. That all of this other stuff, yeah, it was interesting when we started, but we're seeing now that it's really just going to be a hindrance. That we really don't need this low margin stuff anymore. And maybe we don't even need the low margin car business, that we're so advanced that this is the future. So you can make two arguments, and I'm sure the bulls are in the latter argument that that's what's going on. But given what we're seeing right now, and given what experts in the field of automation are saying about the state of full self-driving at level 4 at scale without being geofenced, that it is just an impossibility at this point, given that you don't have a critical mass of these cars on the road, and that is what you truly need. Is you need the sensors in the infrastructure, and you need a critical mass of these cars on the road. Given all of the ICE vehicles, that it just is not a reality. I would seem to say maybe you got 5% on that explanation, 95% on we need to survive the next couple of years. I'd say this is probably what's going on here. However, the short position is working out, but this is a volatile stock, and it moves from headline to headline, and it moves to the upside much easier than it moves to the downside. That if Elon Musk came out and said, I'm working on a flying car, the bulls would say, my car will fly tomorrow and it'll go up $40 in a week on an announcement. That's the following it has. That's the danger of shorting this thing, is any posting on X about any ridiculous thing that may happen in the future will get priced into the stock ridiculously today. That's why you got to be careful how much you do here. And this is really just putting my money where my mouth is, because I think that, the proper valuation of Tesla is somewhere in the range of maybe $30 per share to $60 per share, somewhere in there. And they're sitting at 167. So time will tell, but so far I can, do a little bit of a victory lap, knowing that at any second I could be, knocked out from the knees here. All right, a lot of writing on the screen. I probably could have done this better in a spreadsheet, but I thought, I've already filled out everything on the screen, and it's consistent with the way I do things, so let's just keep going here. The Canadian apartment REITs have reported earnings over the last week. We had Minto, we had Interrent, Killam, and CapREIT, and Northview. Northview had a high yield fund, which then they spun out as more of a REIT. Did very good, but their payout ratio is just a little too high. Let's have a look at some of these. Let's start with CapREIT. Net asset value per share, $54.79 on a fully diluted basis. Their closing price was $46.07, trading at 16% below their net asset value per share. Some statistics here, their change in rents on turnovers. Turnover means somebody moves out and they can bring a new person in, bringing in at market rents. Rents increased 23.2% on people who did move out, on units that turned over, but only 2.4% of their units turn over. How it works with apartments is the higher rents go, the fewer people move out, and the more people who renew. So renewals, rents could only increase 3% on renewals. 45% of the units renewed during the quarter, 45%. So their average monthly rent increased by 4.1% on a weighted basis. Payout on adjusted funds from operations, 60%. I like that number, in around the 60% number. That lowers the probability that the REIT will have to issue shares to do significant expansion. When we get down to Northview Residential, their payout ratio is 96%, so they're more likely to dilute ownership over the next 12 months, let's say, if they want to do any significant capex, whereas you do have some significant space here to do capex without dilution. Killam, net operating income up 8.3% year over year. Net asset value per share is 2025, closed at 1730. They're roughly 14.6% below their net asset value, kind of in line with CapREIT here at about 16%. AFFO payout a little bit higher at 72%. For their NOI, because they add units over time, their same property NOI up 10.3%. On units that did turn over, they increased rents 19.6% versus CapREIT increasing at 23.2%. But a low enough payout out of AFFO so that it minimizes the probability of unit issuance, which would be dilutive. You got to watch that with REITs, right? Because their payouts are so high on a basis of net income, that whenever there's any capex that needed, it typically comes with share issuance, typically comes with dilution. So the lower that number is, the lower the dividend yield is, but the less likely you are to be diluted, the more likely you are to maintain your share value. Let's look at InterRent. Rents for units that were turning over, they were able to increase their rent 20.3%. You see they're all, around the 20%, 20.3 here, 23.2 here, 19.6 here. A net operating income up 11.7% year over year. Net asset value per share 1766, trading at 1214. I was able to pick up 2,000 shares at 1190. I was hoping for more, but that's all I got. 31% below their net asset value. Let's just jump. Their payout from AFFO 61.3, kind of in line with where CapREIT is. Same with Minto, payout 61.7. Average monthly rents here up 8% year over year. Same door rents up 6.6%, or sorry, same door NOI up 6.6%. Net asset value of 22.26. This is my best estimate of their net asset value. I didn't find their net asset value in their press release or their statements, and I didn't feel like combing through to see if I missed it, so I just said, well, I'll just calculate it roughly. Sitting at 1535, sitting 31% below. Both InterRent and Minto have significant exposure to Ontario, where there is more stringent control on how much you can raise rents each year. So they are selling well below their book value per share versus both Killam, which has East Coast exposure, and CapREIT, which has more Canadian-wide exposure, only sitting about 15-16% below their net asset value per share. I think InterRent and Minto look good. I'd like to add more of those. If we look at Northview NII, Northview Residential REIT, they did very well. Same door NOI up 12.2%, but very high payout ratio, about 96%. If that were sitting around 60%, I'd probably put that on a buy list as well. But at 96%, if I had to choose which ones to pick up, I'd probably say, well, look, I got other choices on apartment REITs. I don't need this one. I don't need the diversification of it. If I'm looking for geographical diversification, I can get a lot with Killam, CapREIT, InterRent, and Minto. That I don't need that with that high payout, 96%. So I'll pass on that one. They're more likely to issue units if they want to, let's say, buy more properties or add to their portfolio. They're more likely to dilute ownership to get that done. So I'll pass on that one. I'm still holding CapREIT. I have 28,100 shares. I also have 146 puts, 46 at the $42 mark and 100 at the $45 mark. Am looking to add more. Any weakness on cap rate back down to 45. I am looking at selling the October 45s. I forget what the number in there was. I think it was like 175. Actually, sorry, no, it wasn't the October 45s, because I'm thinking, why would I do that? It was the October 50s, looking at $5.30 if I can get it. The intrinsic value is $3.97. If I can get it for $5.30, that would be good, because I'd get the move up to the $50 mark, which I think it exceeds the $50 mark by the end of the year. As soon as Canada starts cutting rates, REITs will get a bid. So I'm looking for $5.30. So any weakness in the REIT space, in either cap REIT, Killam, Interrent, or Minto, any pullback, I will buy on those. These are solid numbers. These are solid gains. And as you have lower interest rates, the present value of all of that net operating income goes up. And if the present value of all that net operating income goes up, property value goes up at the same time. So you get fair value gains. Over the last couple of years, you've had fair value losses. You'll get fair value gains going forward. So and still, where are you going to go in Canada? If you look at housing prices and housing supply, the supply doesn't exist and the housing prices are too high. Where are you going to go? And we're bringing in, or I say we, like I'm still part of Canada here. Canada's bringing in a level of immigration that the housing market cannot support at this point. I don't know that I have a higher conviction trade beyond this one. I like it, another high conviction trade is selling puts on AT&T at 17. I want to do more of that, but this I think for 2024 is my highest conviction trade. I will break my rules on this one and exceed the size of the positions that I'd like to have, because I mean, it's a winner. It's just a winner. Okay, let's look at SPY. Multiple now at 20.76, up from 20.35. Combination of two things that both increase the multiple is the market went up and the earnings expectations dropped from 250.75 to 250.27 at SPGlobal, from 253.25 to 252.99 at LSEG. And I guess I gotta say it, I don't know how comfortable I am with their estimates. I mean, they can't even get the earnings calendar right, and that's pretty objective. So I don't know. Is it right? I don't know. Who knows? I would seem to think it's just a big hit to their credibility when you can't get something simple right. How are you going to trust the more complex stuff? I mean, if I were them, any of these three companies, I would be saying, I know what I would be doing if I were CEO. I'd be saying, guys, this is killing us. If we can't get this right, who's going to trust anything else that we do? For God's sake, let's get this right. But here we are, right? So, now I'm looking at these going, I don't know. Do you believe them? I don't know. Beats me. But anyways, it's the best we got. Best we got. 20.76 versus 20.35. Surprise factor sitting at 8.3% again. Is that right? I don't know. Adjusted 19.16 times versus 18.77. Just seems a little rich. 20.76. It barely budged when we went from 7 rate cuts being priced in down to only 2 rate cuts being priced in. We pretty much hung out at the same multiple. If we had multiple expansion on the hopes of cuts and those hopes disappear but the multiple never changes, what do we say? That we're still expecting the multiple change? I think so. Implied volatility really disappearing. You can see over here this green line. This is where it was like just a little while ago, a couple weeks ago, and right back down to low 11%. All-time high, 522.95. Less than 1% below the all-time high, 0.579. Isn't it always the case with me in beta? I just can't seem to get this bloody thing right. Anyways, I added to my short position. My average price is now 52.60. I took the opportunity of doing the 5320s along with the 5200s for 5260 for September, and I may sell some options against half that position. I don't know, but I thought, well, I had taken a small initial position to begin with. Let's take a little more because I am looking at adding this week to some of my long positions, so I can afford it. Reporting this week, SPGlobal says 6 companies. LSEG says no, it's 10. Sector Spider says no, it's 7. It's somewhere between 0 and 50 maybe. Somewhere in there. Noticeable ones, Home Depot on Tuesday, big one. I think will set a tone for a while. Walmart on Thursday. You have Deere on Thursday. These are before the market opens. And Applied Material in the semiconductor space after the close. I don't know if you saw this. I don't know what it is with left-leaning governments. Canada has this with the Liberals and the Socialist Party, the NDP, and the U.S. has it with the, I guess you'd call it their progressive liberal / Socialist Party. The Democrats today, I think, lean more towards there, of not recognizing that the fiscal problem is a spending problem, still recognizing it as a revenue problem. They're proposing a 400% increase to the buyback tax. It was 1%. They want to make it 4%. I mean, who thought when they said 1% tax on buybacks, who thought it would stop there, right? I mean, it'll go to 4%. If it goes to 4, they'll do that for a couple of years. It'll go to 7, then 10, then 15. And pretty soon it'll be the same as a capital gains tax. Not recognizing the impact that this has on where capital goes. But here we are, still thinking that we have a revenue problem. I guess if you spend that much, you probably recognize that it's easy to say, I think we have a revenue problem. And then when you get that extra revenue, you say, well, look at this, we're pretty good. We can afford to spend more, thus creating the next revenue problem and not recognizing that you have a spending problem. But it doesn't stop. Four times increase to the buyback tax. Now, this is a proposal. You have an election in November. Based on where the polls are, it looks highly likely you're going to have a Trump presidency for the next 4 years. I don't know what can change other than his trials, I guess, other than some outcome from the trial, whether if he's declared guilty of something, if there's any fallout from that, I don't know. But based on where the polls are right now, it does look like it's a Trump presidency. And in Canada, based on where the polls are right now, it looks like it's a conservative, it will be a conservative majority for the next government. Trump is more likely to extend the Trump tax cuts, surprise, surprise, and probably anything that Biden did, much like he did with Obama, reverse everything that Biden did for no other reason than the fact that Biden did it, not because he agrees or disagrees, just, well, Biden did it, let's get rid of it, like he did with Obama's policies. If Obama's name was on it, it had to go. So he's more likely to just say, no, none of this stuff is going to happen. That increase in the capital gains tax, not going to happen. The expiration of the tax cuts, not going to happen. This tax, not going to happen. So he'll probably cancel all that. Whereas in Canada, Poilievre, I doubt, would cancel any of the taxes that have been instituted on successful people. The increase in the alternative minimum tax, I don't think he's going to touch that. The luxury tax that was introduced on successful people, I don't think he's going to touch that. The capital gains inclusion tax that was introduced on successful people, I don't think he's going to touch that. I think that successful people will probably have a better time in the U.S. with Trump and no change. I don't think he'll increase any more taxes. I think Liberals and NDP definitely would continue to increase taxes. So I think if you're successful in Canada, you have that going for you, but don't look for any relief. But I do think that he will cut spending significantly, whereas Trump probably might not cut the spending, but he will cut taxes, making the deficit worse. The Conservatives may make the deficit better. Poilievre has said that that is his goal, is a balanced budget. So I think he will be beneficial for the deficit and the debt, whereas Trump will not. But he will be beneficial for successful people, whereas in Canada, well, it won't get any worse, but it's not going to get any better. But this is a hit to a lot of, and I don't think they quite understand what's going on here. That if we look at who owns equities, it is Social Security, for example, that is the beneficiary of a lot of capital gains. It is pension funds across the country. It is mutual funds held by mom and pop across the country. It's not just successful people here. This is, to me, just, hey, listen, we need to come up with revenue because we have a revenue problem, and let's do this. Doesn't seem to be well advised. Anyways, I'll stop there on that. I think you all know my position on excessive taxation. I don't need to, I guess, keep going over it, as somebody mentioned maybe that I shouldn't. So anyways, this week, CPI on Wednesday is the big one. And Walmart, as far as the market goes, and the health of the consumer. Also, I believe on Wednesday, retail sales coming after Home Depot reports and before Walmart reports. And that's it for this week.